Welcome, University of Waterloo. Please stay muted unless you are speaking. I will start time as soon as a member of your team utters the first word. You will receive a 1 minute warning and time will end at precisely 10 minutes. Please feel free to begin.
Grocery retail in Canada is widely regarded as stable and mature. Empire Company Limited, the second largest player in this space, has new management that continues to turn around the business, unlocking value for investors who are hungry for return. Following the recent launch of Empire's second multi-year initiative, we are pitching a buy recommendation on the stock with a target price of $47 per share. Before we discuss our investment thesis, we first want to share what led to this turnaround story. As a consumer staple, the core of Empire's operations is grocery retail, consisting primarily of conventional, discount, and premium stores. This is supplemented by real estate investments in Crombie and Genstar.
In 2013, Empire acquired Safeway, a Western Canadian grocery retailer, but integration issues led to impairment charges totaling $3 billion in 2016. This sparked a management turnover, starting with the appointment of CEO Michael Medline, who wasted no time in launching Project Sunrise, a 3-year initiative to start turning around the business. The 3-year project consisted of realizing various cost efficiencies and was successfully completed in May 2020, achieving $550 million of EBITDA expansion, 10% more than originally forecasted.
Despite its success, Project Sunrise only narrowed the gap between Empire and its peers. In order to realign its margins, there are still further improvements to be made, which brings us to Project Horizon. In July 2020, led by the same management team that exceeded expectations of Project Sunrise, Empire launched another 3-year initiative called Project Horizon that is twofold in nature: growth in market share and greater cost discipline. This leads to our investment thesis that management will continue to turn around the business as they execute on Project Horizon. More specifically, they will achieve this through their solidified base, realigned core, and industry-leading growth initiatives.
First, in order to realize the benefits from Project Horizon, Empire requires a strong base to build upon. Through our primary research that included data scraping locations and determining distances, we found 70% of Empire stores were conveniently located within a 10-minute drive of Canadians. Given minimal industry store turnover, Empire stores will continue to be conveniently located and are best positioned amongst peers to capitalize on the long-term demographic shift to suburban areas that was catalyzed by COVID-19. Empire's strong real estate positioning is attributable to their investments in Crombie and Genstar. The complementary nature of these businesses to Empire's core operations is critical in facilitating competitive store locations. We believe Empire has solidified its strong positioning, which lays the foundation for Project Horizon.
With this solid base, Empire is set to execute on Project Horizon. One of its major initiatives is realigning core offerings to capitalize on long-term trends. Private labels have higher margins and continue to grow faster than national brands. Given their attractiveness to consumers, we expect Canadian market penetration to close the gap versus other developed nations, indicating more runway for adoption. Our team conducted primary research using a basket of goods and our own consumer survey to create this price-quality matrix. We found that while Compliments offers quality in line with its price point, the brand lacked awareness amongst consumers. To address this, Empire rebranded Compliments, leading it to outperform all private labels in fiscal year 2020. Through a discussion with industry professionals, including the agency who led the rebrand and our team's additional research, we expect Compliments to continue its strong performance, benefit from increased private label adoption, and catch up to peers. Empire has also successfully rebranded their FreshCo banner to capitalize on the rise of discount grocers. Discount is growing faster than conventional in Canada, and penetration lags other developed countries, again indicating more runway for adoption. Leveraging this successful rebrand and favorable long-term trends, Empire is replacing underperforming conventional Safeway stores with FreshCo stores, which better align with Western Canada's preferences. Empire is turning Western Canada's economic headwinds into company tailwinds. With these rebranding investments, Empire is set to capitalize on these industry trends and bolster its core private label and discount offerings.
Lastly, Empire is investing in a best-in-class e-commerce solution and industry-leading premium grocery stores. E-commerce as a whole has seen a jump in adoption due to COVID-19, and grocery is no exception, as confirmed through our team's consumer survey. To capture this rising trend, which we expect to continue growing post-pandemic, Empire entered into an exclusive partnership with Ocado, the world-leading solution for picking and packing e-commerce grocery orders. While competitors rely on individuals to prepare orders, Ocado's robotic solution has lower variable costs and is substantially more scalable. Ocado is a long-term solution to a long-term trend that best positions Empire compared to alternative short-term solutions used by peers. Empire's national e-commerce platform, Voila, not only outperforms peers on long-term financial performance, but also stands out for its value proposition to consumers. After benchmarking each service using a basket of goods, user experience analysis, and Amazon's website traffic analytics, we found that Voila is the only offering in first or second across all metrics. Acquired in 2018, Farm Boy is a premium grocery store offering high-quality products, including their own private label, and prices that are 30% cheaper than its competitor Whole Foods. Another part of their value proposition is their quality customer service, as illustrated by their near-perfect store ratings, based on 686,000 Google reviews. This proven business model has demonstrated impressive same-store sales growth and industry-leading margins. Given its superior metrics and a product offering that resonates with the Greater Toronto Area, Empire plans to strategically double the store count of Farm Boy by the end of fiscal year 2024.
Moving on to our valuation, which is composed of both relative and intrinsic methodologies. For our comparables valuation, our universe consists of competitors and comparable businesses. We remove Costco and Walmart as they both operate under a different business model. Empire currently trades at a slight discount to peers on an EBITDA basis. For our intrinsic valuation, the primary driver of value is the margin expansions. We expect EBITDA expansion to be 50 basis points over the life of Project Horizon, which is driven by private labels, Freshco, and Farm Boy, while being partially offset by Voila, which is dilutive in the short term. Additional assumptions with regards to growth, discount rates, and terminal value are made to get to a valuation of $41 for the retail operations of Empire. Our intrinsic valuation is a sum of the parts, where we valued Crombie using a NAV model and Genstar carrying value given it is privately held. Since the three businesses are complementary, no conglomerate discount was applied when consolidating. Ultimately, our intrinsic valuation comes to an applied share price today of $45 with an upside of 14%. Using an equal weighting of all valuation methods, we found a 12-month target price of $47, indicating a 20% return. Investors continue to treat Empire as a show-me story, so major stock catalysts include earnings beats and the achievement of Project Horizon milestones, which is consistent with the stock performance over the course of Project Sunrise.
We have identified a few risks that Empire's business faces, and we'd like to analyze the two largest risks, being Empire's failure to realize cost savings and our dual-class share structure. We recognize that Project Horizon initiatives play a pivotal role in our valuation. To quantify the risk that no benefits are realized, we projected a conservative status quo case, which resulted in a minimal 3% downside to its current price, showing that any success of Project Horizon offers upside. Second, we recognize that Empire's public Class A shares possess no voting rights. Along with a variety of other mitigants, we believe the market's rising confidence in Empire's management, as demonstrated by realignment of multiples following their appointment, justifies placing no discount on the non-voting shares. Even if there were a premium for the voting shares, we found the impact to our target price to be less than 6%.
Although the lack of voting rights did negatively impact the company's governance score in our internally developed ESG scorecard assessment, we believe the risk is well mitigated for the reasons mentioned previously. As ESG ratings are both an art and a science, our scorecard incorporated dozens of other material factors, such as the company's focus on food waste, employee satisfaction, and management incentives. After performing the same ESG analysis on its peers, Empire's score gives us reassurance that they are indeed an ESG-friendly investment. In conclusion, management's proven ability to execute on its strategic initiatives gives us confidence they will unlock value through Project Horizon. This solidifies our overall investment thesis that the turnaround story is still ongoing, which is why we see a bright future on the horizon for Empire. Thank you very much for your time. We now like to open it up for any questions.
Check. Before we start the judge Q&A, we just want to make sure that the team member that dropped, that we can hear you. We just want to do a quick sound check. Noah?
Yeah, I think it should be okay.
Okay, great. We can hear you perfectly.
Thanks.
Okay. Judges, if you can please turn your videos back on. I will start time as soon as the first judge asks the first question. Time will end at 10 minutes. Feel free to begin.
Well, congratulations on your presentation. Empire recently announced a buyback of 5 to 8.5 million shares. Does this can impact your valuation in any way, and how?
So we do note, yes, they did increase their normal course issuer bid. And we actually see this as a positive, as we also agree that the shares are undervalued. And if we look, the company recently was BB rated with their bonds, and they've been buying back debt as well, which brought them to BBB, so investment grade. So we see this not really impacting our discount rate, as we'll be buying back both debt and equity.
And is this the best way to use cash now? Why or why not?
So if you just look at their... Oh, go ahead, Noah.
Because of COVID-19, they've actually had seen an increase in operating cash flows, so they do have excess cash right now. And as Brendan mentioned, the stock is undervalued, in our opinion and management's opinion. So buying back shares is a good use of capital at this moment, as well as historically buying back debt. It was necessary because they were BB rated, and investment grade is something that management wanted their bonds to be rated.
Thank you, Team T. Simon. Can you walk us through a little bit on how Empire has navigated themselves through the COVID compared to their competitors? Of course, you have touched on the e-commerce piece of it. Can you elaborate a little bit more on the other areas that they have done it right during this pandemic? While around the world, we do see retail has taken quite a bad hit during this period of time.
Yes. So in terms of the impact of COVID-19 on Empire's business, we have seen unprecedented same-store sales growth in the double-digit figures. However, in our projection period, we recognize that this is a one-time impact, and we have revenues returning to pre-pandemic levels after fiscal year 2022 as restrictions are lifted. In terms of Empire's reaction to COVID-19, we note that they actually have the highest hero pay out of all their competitors, which shows that they value their customers, as well as the safety of their customers, as well as the well-being of their employees. Now, in terms of the impact, long-term impact of COVID-19, we conducted a consumer survey to gauge what trends have arose during COVID-19, and we found two trends are here to stay. The first being the increasing importance of cleanliness and safety, and the second being the increased adoption of e-commerce as consumers look towards alternatives to in-store shopping.
Thank you. I actually liked your presentation quite a bit. I want to ask a question around the survey, right? It's great that you take that initiative and do the survey. So how large was the sample of your survey? What was the geographic location? And how do you make sure that it's representative of the broad client base that this company has?
Yeah, so as Anna mentioned, we did conduct this consumer survey. It was 140 respondents from coast to coast across all of Canada, and an age ranging from 17 to about 90 years old, and a very uniform distribution across that.
And in terms of why we have confidence in our survey, we found that price, quality, and location are the most important factors. And all of this research was backed up by secondary research. And so we had confirmation there. And through our basket of goods, as well as our consumer survey, as well as our industry expert calls, we were able to incorporate this information and really allowed us to gain confidence in the robustness of Empire's defensive moat, as well as our overall valuation.
So is Canada the primary market for this company?
Canada is the only market. So their stores are located only in Canada. Yes.
So does it make it more vulnerable because it doesn't have a more wider client base than kind of another one? Some of the examples you've given tend to be a bit more geographically dispersed.
So if we look at the Canadian just market overall, Loblaw and Metro are the other two pure play grocers here in Canada. And it's really an oligopoly between those three, and all three are purely just in Canada. Costco and Walmart, again, are just different business models in general, and they're more global. So we don't see this as a negative. It seems it's just industry practice for these grocers to focus just on Canada. Similar to the US, you have Kroger and Albertsons just focused in the US.
Okay, thanks.
I would just follow up on your question and continue on the improvement of brand awareness and positioning in terms of market share in Canada. Maybe you can elaborate on that.
Yes. So we conducted a price quality matrix to benchmark the different private labels in the Canadian market. So for basket of goods, we actually individually went into each store, priced an identical basket of goods to proxy price rating. And then for the quality rating, we conducted our consumer survey to gauge perceived quality of consumers towards these brands. And we found that historically, compliments, despite offering quality in line with price, they were lacking a little bit on the brand awareness side. But we conducted additional research and spoke to industry experts, including Ellen Dougal, who is the VP of strategy at the marketing agency who conducted the rebrand. And he stated that the rebrand made packaging more bolder, more vibrant, overall made the product more attractive. And as private labels are 20 to 30% higher in margins, we see this having a positive impact to Empire's product mix. And on top of that, compliments will move up on this chart to being more favorable and in line with other peers in the market.
Can you walk us through a little bit this time again? Can you walk us through a little bit on what is the assumption behind your derivation of your WACC and your cost of equity?
Sure. So to calculate our WACC, we first started with the cost of debt, and we used the yield on Empire's publicly traded bonds, which was 4.1%. And then we sense checked this with a synthetic credit spread with a BBB bond, and we found it was largely in line. For cost of equity, we initially went down the path of using the CAPM methodology with a beta of 0.2. And we found a cost of equity of 2.6%, which we didn't think was reflective of the risk and return that investors in Empire would require. When we looked at peer beta, we actually found it was closer to 0. So we opted against using the CAPM methodology and instead used the DDM approach to find a cost of equity of 7.3%, which we felt better reflected the risk return of investors in Empire. And to calculate our WACC, we assumed a constant capital structure and found 5.7%.
Okay, thank you.
Well, if I may, I have another question regarding this buyback of debt. The company's ratio of debt to assets is about 47%, which is quite affordable, quite manageable. So this debt buyback is, I guess, not because they want to deleverage the company, but because they want to find better financial conditions for financing the company. Is this the right approach?
So you're right. If we look at just the debt details that they have, we list them here. The coupon rate is more reflective because when the debt was issued under their BB rating, which is actually junk bond rating. But now that they've been brought up to BBB, like you mentioned, they will be buying this back to get more preferential debt treatment in the future. as they go on with Project Horizon.
And their credit rating was so low because of that acquisition that they had to underwrite. Is that why?
Yes. They took on some debt for the Safeway acquisition, and it went sideways, and that resulted in the lowering of the credit rating.
Could you go through Ocado acquisition and the synergies that were reflected?
So just a quick clarifying point, Ocado is a separately traded company in the UK. So it is simply just a partnership, but the synergies that we're talking about here are more so working together to launch Voilà's customer fulfillment center.
Time.
Thank you, University of Waterloo.
Thank you very much.
Thank you.
Thank you.
This time, all teams have presented